All right, so I haven't made a video in a while, and today I'm just going to go over what the Federal Reserve did. As you can see here on the news, if my device works. So the Federal Reserve cuts rates to zero and launches a massive 700 billion quantitative easing program. So if you guys don't know, this has happened in 2008. Here we have a chart that shows the quantitative easing that occurred between December Now, between November and December of 2008, we had the first QE announcement. To be exact, November 25th, 2008. The markets kind of rallied up and then they went back down. And then they had something called QE1 expanded on around March of 2009, uh, like 5 months later. And that's when pretty much the market bottomed. And then from there, it just kept going up forever since now. And to now, we have this chart. Let's say the overall market, Dow Jones. Um, it's been falling dramatically. It went from the top to bottom of the recent top and bottom, and 9,000 points. It has dropped. We can see here in the 1 year period, it has pretty much taken us back to like 3 years back, maybe 2017, late 2017, and that's pretty much the lowest it has taken. The lowest it went was mid 2017, and which is pretty low. It's a dramatic move. I think the total we dropped from 29 to 21. It's about a 20% drop or more. Yeah, for sure more. If I were to do the math, 9,000 of 9,000 of 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 29. That's about 31% drop that we had. But then we had a big bounce, and that was a dramatic bounce. That says something. Um, but yeah, I think the market is gonna bounce back. The numbers I like to look at is unemployment, but unemployment has still continued to trend downwards. As we've seen in the previous recession, unemployment went up, and that's when 5 months after the bottom of unemployment, of consecutive increasing unemployment rates, we had eventually the top of the market. And the top of the market pretty much just means that the the bull market was over and now we're heading in a recession. But it only took a year before it started to drop, and that's when the here in the chart it said November 2008. That's when the Federal Reserve started pumping money into the markets. So November 2008, the Federal Reserve pumped money into the markets, and unemployment continued to go higher. But that was probably just something that's going to happen because unemployment rates are slower to report once a month. But markets, in terms of the stock market, responds very fast. They have news and they will respond immediately by just knowing and pricing in what's going to happen. What they see happening is probably that they are feeling that this money is just going to help the markets, which it possibly can and it did in the past. My approach is that I'll probably go into the markets a little bit, legging in little by little, buying some shares. That's my personal approach. I do not recommend anybody doing what I do. I am not a financial advisor, so do not follow what I say. This is just my personal opinion. My opinion. So I first read the news. I heard some stuff about repo markets pumping or like pretty much allowing some liquidity in the markets. I'm not quite educated on that, but I knew something was up with especially the markets dropping so dramatically that I had a feeling that with also coronavirus having an effect on the world, the Federal Reserve would step in, and they had said in the past that they would step in and do anything possible to help the markets continue upwards or support it at least. And the best thing that they could have done, or in their opinion, is that they wanted to just continue QE in terms of like initiating it since pretty much 10 years later after 2008. It's actually been 12 years since 2008, and now we have QE, and QE is officially pumping in money into the markets by having the Federal Reserve purchase assets from banks, and banks now have credit which they can lend out into the economy, and the economy will benefit from that, but it will not necessarily solve the problem. It's just a temporary fixture. So I have no idea what's going to happen to the Dow Jones moving forward. I do expect it to kind of respond to it in a positive, bullish way, but the effects of the coronavirus and the credit markets are going to be ambiguous. We don't know what's going to happen because have we don't have a clue as to the coronavirus will be contained. It is still too early on to know what's going to happen because countries are still being affected. They're still struggling to have it contained. We just have to wait for the news of whether there is a vaccine, of we have, or whether we have successfully contained it, and we just need more information on that. But also, other economists, other people who are well educated about the markets. For instance, Peter Schiff. He's a great guy when it comes to talking about the markets. If we go to his YouTube, Peter Schiff. Peter Schiff was pretty much predicting this in forever. Just posted this video.
I think what's going to happen is when the Fed goes back to zero, which is what they're going to do, they're not just going to cut 25, 50 basis points. They're going back to zero, but there's not a lot of room between where we are now and zero.
We're at two and a quarter to 2.5.
So what the real stimulus is going to be is QE4, which is going to be bigger than the first three rounds combined.
Wait, is that your prediction?
Oh, yes.
You say, okay, articulate it here.
Well, the Fed's going to go back to QE. I mean, they're going to do whatever they can to try to stop the bear market and to try to prevent the recession, but they are going to fail. They're going to make it worse this time.
So there you have it. He posted a 30-minute video just to show people that he has called it. He knew it's going to happen. He said that the bubble, we're currently in a bubble, and it was the coronavirus that was just a needle to prick the bubble, but it could have been anything to prick the bubble. Here we have James Cramer. I'll probably watch it later. But also, another thing that the Federal Reserve did, they cut interest rates. So here we have the effective federal funds rate, which is how much the Federal Reserve will charge banks, institutional banks, interest for pretty much laying out money. And in the bull market from 2009 all the way to the present, or in the past, before today, 5 months ago, we had really nice uptrends, bull markets. We had almost 0% interest for a very long time. Then interests were increasing, and that probably had an effect. The increasing rates had an effect on the markets, and now they had resort to cutting rates. And recently they cut rates because of the coronavirus, and now they cut it even more, and also implemented quantitative easing. That is for sure, in my opinion. Actually, I'm not gonna say for sure. I don't know, but I speculate that markets will be bullish from here unless there's something bigger behind the scenes playing. For instance, there might be companies that will not be able to meet their revenues or profit margin or profit uh, goals, and will have to lay off people. So, and all in all, my biggest thing to look at is unemployment. If our unemployment increases, that's a actual sign of markets that will suffer dramatically, because if we have people who are going through unemployment, that means we have less money to be used to purchase goods and services, which will leave companies with less money, and it's just a domino effect from there. But what happened in 2008, that same thing happened. Unemployment was occurring due to people not able to afford um, their mortgages, and when mortgages were not paid, banks kind of can't lend to companies, and companies can't hire people or can have to lay off people, and it's just a crazy effect. But what the government did was pump money into the market so that you know the companies could borrow money to pay for expenses and fix the issue. Not really fix the issue, but just kind of alleviate what has happened. And if that's the thing that's happening right now, before unemployment gets to a point where it's not manageable, then we won't see unemployment go down. We'll just see a little bump on unemployment probably for the short term, but it will be a great bump because we have big signs of people, companies not having things that normally occur like events and sporting events. They're having canceled for the whole season, which is dramatic. I expect to see a big increase from this March to March to April, which would be a big jump, and that's gonna spook the markets for sure. So I'm gonna hold back. I'm probably just gonna buy a few shares personally. My personal opinion. Anything could happen. Anything will happen, and and do your own research. This is just my opinion, and with that, I'll leave you all uh, to the news. Just see what's happening with news. If we go to um, the markets on Google News, we can see. Don't try to call bottom for the whole market. Instead, pick stocks for the long term. Yeah, makes sense. Yeah, it's crazy. So yeah, they're just trying to avoid a recession with the coronavirus. That's what's happening. Prolong the bull market before it gets worse. Um, but eventually, if it was not the coronavirus, it would be something else, and it might be something else in the future. It's just crazy. Um, Trump, of course, would love this because it would help him be run for run and also get the votes because he did something that propped up markets. He'll get the votes of middle class and upper class people. Um, this, of course, also helps the low income people because they're not losing their jobs. So it's a move that's necessary. Whether you think the coronavirus is a conspiracy or not, it's just something that's happening, and try to figure out your own way of how you're going to deal with this. If you're not in the markets, don't even worry about it. Just try to maintain your job. um, Hopefully you keep your job and companies are not affected by the coronavirus too bad. So see you on the next video, and ciao.